In financial markets, it helps not to be a sheep, frankly. I think the herd is often wrong. Don't accept consensus thinking. You must try and understand what's driving that thinking, whether it makes sense or whether it really is motivated by something fundamental. But I thought it was really refreshing to see Powell's honesty in his speech when he said,
it's challenging to know what to do.
Some, I think, erroneously might see that as a sign of weakness. I see that as a sign of strength. This is undoubtedly good news.
It's a great day for the special relationship.
You've got a number of very big US institutions committing to investing in the UK economy. But I think we also need to moderate our enthusiasm a little bit.
Welcome to the W4.0 roundup of the week, where we cut through the headlines to look at the bigger pictures in markets and the economy. I'm joined, as always, by Neil Woodford. Hi, Neil.
Hi, John.
This week, the Bank of England held rates while the Fed cuts, and Powell admitted it's more art than science. Trump declares a breakthrough with China and a deal to save TikTok, while Beijing bans Nvidia's AI chips. And the UK is caught between pressure on business and promises of billions in US investment. Plenty to cover, as always, Neil.
You bet, yeah.
Neil, I wanted to start with something a little different this week. You've built a reputation as a contrarian investor, someone who often goes against the consensus. Was that always your instinct, or was it something you learned from someone along the way?
It's a good question, John. I think it's a mixture of both, actually. I think instinctively, I'm somebody who doesn't accept or doesn't embrace accepted wisdom. I like to try and make my own mind up about things. And I think in financial markets, it helps not to be a sheep, frankly. I think the herd is often wrong in financial markets. And so that sort of natural inclination to want to question consensus thinking, accepted wisdom, I think has served me well through my career and continues to do so. And I think perhaps as an aside, in a world where social media disseminates consensus thinking so comprehensively, if anything, consensus expectations, consensus thinking can be even more sort of dominant than it might have been when I first started working in this industry. So I think that's the important thing to bear in mind too. As for what I learned about contrarian thinking, it's not that it's important to emphasize it. I think to be a sheep following a herd is not a particularly sensible strategy in financial markets, but neither is it just to be a contrarian for the sake of being a contrarian. I think you've got to really think through everything. And I think it's that desire to want to analyze and understand why things are happening, what's driving a particular trend or a particular sort of reaction in financial markets to events. It's that sort of innate need or desire to really understand what's going on is, I think, what I learned from people that I respected in the industry and people I've looked up to over time. Not just people I've known, but people that I've sort of read about, not least, of course, people like Warren Buffett.
So this isn't about being a contrarian for the sake of it. That's not what you're saying. What you're saying is when you see a sort of collective mentality, your natural desire is to try to understand or challenge it. Is that right?
Yeah, that's correct. I think it's a good instinct to cultivate for an investor. If you just accept all the time what the market tells you, what the media consensus is telling you about a particular issue, or accept that everything that the market does is rational and sensible, you will end up, I think, in a very deep hole. I think it's very, very healthy to develop a skeptical mind, an inquiring mind in financial markets. It was important when I first started. It's, if anything, even more important now. Don't accept consensus thinking. Importantly, that I'm not saying that consensus thinking is always wrong. What I am saying is that you must try and understand what's driving that thinking, whether it makes sense, whether it's just a sort of hysterical sort of background noise, or whether it really is motivated by something fundamental.
Thanks, Neil. That's really interesting. Let's talk about the news that everyone seemed to be waiting for this week. The Fed cut rates by 0.25% on Wednesday. At first glance, that seems like a small move, but the chairman, Jerome Powell, framed it quite differently, highlighting the uncertainty of policymaking compared with the way that central bankers often present themselves. Could you give us a rundown of what the Fed actually said and what stood out to you in his remarks?
Just a quick summary. So the Fed have cut by 25 basis points. It's the first cut this year. The Fed have resisted a lot of political pressure to cut rates. So the committee, which I think is now 12 strong, has decided to cut rates by 25 basis points to 4%. We've actually, it's a range, but it's effectively 4%. What Powell did, I think, was pretty significant. He managed to sort of assemble the committee members around a consensus view, which was to cut by 25, although inherently I think views on the committee are quite far apart in some respects. One member of the committee, the new member that only just took up his seat, who is effectively a Trump appointee or a Trump recommended appointee, Stephen Mirren, he voted for a 50 basis points cut. So that's the sort of detail of what happened. The dot plots, which tell you, are effectively the sort of the assembled views of the 12 members of the committee, projected forward over, I think, 3 or 4 years, and then over the long term. Those dot plots, which are anonymous, tell you how the consensus in the committee is shifting over time. And the dot plots broadly have shifted down a little bit at this meeting. So I think what that's telling you is that on the whole, on average, the committee members are expecting rates to be lower now than they were previously. And I think there's good rationale for that. The motivation for that rate cut decision is twofold, really. Remember, it's important to remember that the Fed, unlike the Bank of England, has a dual mandate to deliver optimum levels of employment, but also to fight inflation. And I think on those two fronts, first of all, the labour market has clearly deteriorated over the last 4 or 5 months. Back in April, the labour market was firm, strong, job creation was good. Not the case now. So the labour market has deteriorated through May, June, July, through the summer. And I think that was a significant factor. The latest data was really quite weak, actually, and highlighted a potential issue in the labour market. So I think the Fed felt it needed to act, first of all, to ease policy to help the labour market. And secondly, and this is something that the Fed admitted to and Powell admitted to yesterday, their initial guess about the inflationary consequences of Trump's Trump's tariffs was wrong. I sort of hinted at this back in April this year. I thought that everybody was getting a bit carried away with the headline sort of tariff rates and on what the eventual implications of those tariffs would be over time. And the Fed has now admitted that, first of all, that they overestimated the impact of the tariffs, and they overestimated the timescale on which those tariffs would impact the US economy. So basically, they said they got that wrong. And as a result, the inflationary consequences of those tariffs, their view on that is much more moderate now than it was, or they're much less concerned now than they were a few months ago. Now, going forward, I still think the Fed, there's a degree of uncertainty about where rates should be, and how inflation will develop and how growth will develop, how the labour market will develop in the US. And these are always the uncertainties that any policymaker confronts. But I thought it was really refreshing to see Powell's honesty in his speech when he said, it's really challenging to know what to do. Now, some, I think, erroneously might see that as a sign of weakness. I see that as a sign of strength, and it's a sort of truthful thing, frankly. It's not always abundantly clear what you should do with rates. I think you've got to develop a view, and explain that view. But you've got to be open to new data. You've got to be open to how data evolves. You've got to be open to the fact that you might get things wrong. And I think that's a really refreshing bout of honesty from the Fed. I really like the way the Fed talk about how they set policy. And it's in stark contrast to the sort of mechanistic view that I think we get from, say, the Bank of England's Monetary Policy Committee. They tend to couch their opinions in, well, they hide behind academic economic constructs that I think are very unhelpful, like capacity utilization, what sort of spare capacity there is in the economy, completely unmeasurable, by the way, what the non-inflation growth path of the economy will be, what the non-inflationary rate of interest might be. All of these things are sort of academic concepts, but they're completely unmeasurable. And I really don't like the fact that the NBC keep spouting these sort of academic concepts that are, in my view, totally unhelpful in trying to set policy. Policy should be set, as the Fed reminds us every single time they opine on these things, it should be set based on how the data is evolving. If you peer too far into the future, you can get all sorts of, I think, poor signals about what you should be doing now to set policy rates. So my view is the Fed have got the right approach. It's a pragmatic approach. It's data-driven. And you've got a Fed governor who's pretty honest about the uncertainties inherent in that process. And I think the MPC could learn a lot from the way the Fed approaches this subject.
I certainly have sympathy with not always knowing exactly what you should do. So at least we've got that in common.
Yeah.
In the UK, the Bank of England also announced its decision on rates earlier today. The expectation, of course, was that rates would stay on hold, which is exactly what happened. But there were some last-minute rumours of a scaling back of quantitative tightening. Neil, tell us what happened, first of all, and then let's look at what it might tell us about what the bank is worried about for the future.
The Bank of England left rates on hold. I think there was a near 100% certainty that was going to be, or 100% expectation that would be the result. They cut rates last month, remember, so there was really no probability of a cut this time round. The additional thing of interest is that the bank has decided to scale back quantitative tightening. So at the moment, you'll remember, just to put this into context, in the aftermath of the financial crisis, when rates were as low as they could go, more monetary policy stimulus was required. And that took the form of this thing called quantitative easing, where effectively money was printed. And with that printed money, effectively, the Bank of England bought gilts as a stimulative measure. In the aftermath of the near normalization of economic conditions, so as the after effects of the financial crisis sort of ebbed away, I still think we live with some of them, by the way, but nevertheless, the majority of the sort of deflationary consequences of the financial crisis are now behind us. Nevertheless, so what's now happening is that the bank sees it as a sort of sign of sort of financial sort of an appropriate response to the sort of passing of the crisis, is that the gilts that they bought during QE should be sold back to the market through a quantitative tightening program, effectively selling gilts back to the market. The current run rate is about £100 billion worth of gilts a year from QT. And the book of government debt so during QE, Bank of England bought between 900 billion and £1 trillion worth of gilts, and it's now selling those back to the market. I think it's now down to about 550 odd million, having sold over 400 million pounds worth of gilts. The run rate, what the decision that's been taken by the Bank of England is to reduce the run rate of sales. So they cut it from 100 billion to 70 billion. Why have they done that? There is a feeling in the market, in the gilt market, that the pace of QT was putting upward pressure on rates. The sort of more sellers than buyers argument was pushing gilt prices down, yields up. And the view, I think, that view has sort of gained currency in the Bank of England, and they've now responded to that by reducing the extent of QT by reducing it from £100 billion a year to 70 billion. At the margin, it feels quite sort of meaningless, but I think it's just at the margin, it's significant. 30 billion reduction in gilt sales. All other things being equal, that will help the gilt market. It will help yields to come down. And of course, we should all be focused on the impact of high gilt yields, because of course, high gilt yields, high inflation has driven up the cost of funding the national debt, partly because we've issued so much index-linked debt in the past. And we all have a vested interest in seeing the cost of servicing that debt come down. This, I think, will help in that, as will, of course, lower inflation, which will bring the coupon down on the book of outstanding index-linked debt as well.
More broadly, do you think the bank has been too slow to adjust compared to its peer group?
Yes, I do. Yeah, I think I disagree. I've written about this on many occasions. I disagree with first of all the Bank of England's the Monetary Policy Committee's sort of caution. I think they have muddled thinking. I think they rely way too much, as I've just said, on academic economic concepts that have absolutely no use in guiding policy, in my view. They are unmeasurable. If they're unmeasurable, how can they possibly guide you to make the right decision about policy? I think they've been too cautious. I think they've got too many academic economists on the MPC, not enough pragmatists, not enough people with real business experience, not enough people with real world experience of what it's like to run a business. Yeah, I think they've been too cautious. At the margin, I could understand, because of course headline rate of inflation in the UK is higher than in Europe and in the US, but we all know why that headline rate is as high as it was. Remember, not that long ago, before the administered inflationary effects came through, we had inflation rate below target, below 2%. But then administered inflation drove the headline inflation rate, the CPI, up to now where it is at 3.8%. Those effects are one-off, in my view. And if you want a sort of guide to where inflation is headed, look no further than pay settlements, which are now down at 3% in the UK in the private sector. I'm very confident that inflation is headed back down towards the 2% government target, or 2% MPC target, or Bank of England target, by the middle of next year. So yes, I would urge the committee to get on and cut rates. They're too high in the UK. They're an impediment to growth. They're holding back the economy. The Bank of England actually admits that is the case. And we need to get rates down, and we need to get them down promptly.
Now, Donald Trump has said on his social network that a deal is close to being struck between Washington and Beijing over TikTok, alongside their broader trade talks. Is this the beginning of a shift in the direction of US-China relations, or is it just Trump being Trump?
No, I think this is important. I think on both sides, I think both China and the US have recognized that an increasingly, back where we were in April, where the two were announcing ridiculously high tariff rates on each other's exports, and there was a sort of escalation going on, which looked crazy. Both sides have recognized that is in nobody's interest, and certainly not in the interest of China or the US. So I think these two very important global trading partners, the two, frankly, global superpowers, who will forever, well, for as long as I can imagine, confront each other sort of geopolitically, have also recognized that it's mutually damaging to pursue this sort of escalating trade dispute. So a lot of heat and light has come out of that. Trade discussions have been going on pretty continuously since April. A number of meetings have taken place. The latest took place in Madrid, I think, a few days ago, and the discussions seem to be going really well, and they seem to be sort of headed towards a President Xi, President Trump summit, where a grand trade deal will be signed sometime maybe in October or November this year. But the TikTok deal is important because it was an impediment to getting that sort of comprehensive trade deal in place. So what's been agreed is that, remember, Biden banned TikTok in the US. What's now been agreed is that TikTok US will be sold by ByteDance to a consortium largely of US investors, including Oracle. They will comprise 80% of the shareholders. ByteDance will retain 20%. The board of directors of TikTok US will be predominantly US citizens. So there's been a degree of China giving way on some of these issues, and that I think is a mark of the determination to get to an all-encompassing bigger deal on trade. So this is an important aspect of the circumstances that need to be in place ahead of a comprehensive deal. So I think it's really important. It's not Trump being Trump. It's a proper trade discussion,
proper progress.
Yeah.
Sticking with China, the regulators there have just barred the country's biggest tech firms from buying any of Nvidia's AI chips, which is a pretty big escalation. Does this accelerate China's push for self-sufficiency in AI and in chip making, or does it risk slowing down innovation there by cutting off access to the best hardware in the world? What do you think?
I think this is part and parcel of the geopolitical thing I've just alluded to. The AI industrial revolution is a race that both countries understand that they really can't come second in. Now, clearly, by definition, I suppose there could be a tie, but by definition, somebody's going to lead and win that race. I think the US clearly has a lead, and its technology is significantly ahead of China's inherent, certainly chip technology. But I think China's working very hard and closing that gap. So the US economy, US leading technology stocks, US chip stocks, not least Nvidia, of course, have got to work hard to maintain that lead. Now, what I think this latest decision by the Chinese regulator to ban imports of chips or to ban companies from buying chips from the US is a sign that the Chinese regulator believes that China's chip technology has now advanced sufficiently that its technology companies like Alibaba, ByteDance, Baidu, all these companies that are developing large language models, that are developing their AI capabilities, should now be relying on home-produced, home-developed chip technology and not become reliant, absolutely not become reliant, as they have been historically, on US technology, US chip technology. These chips, by the way, the latest ban is on chips that were used in industrial processes, that they weren't used in AI applications. Nvidia's H20 chip, which is specifically used in AI applications, which was essentially an Nvidia China market chip, specifically a bespoke chip for China, that basically companies were banned from using those earlier on this year. So the conclusion is this is a sign that China believes that its domestic chip technology has developed sufficiently to such that the domestic technology companies can now rely on that chip technology and don't now need to rely on US chip technology.
There was an interesting story that just broke a few minutes ago about Nvidia investing $5 billion into Intel, which seems like maybe Nvidia trying to make sure that they've got manufacturing capability in the US rather than relying on TSMC in Taiwan.
I think TSMC, Taiwanese company with the majority of its manufacturing infrastructure in Taiwan, has 65% of the global foundry market. I mean, it just makes sense for Nvidia to think about having alternatives. I'm not saying they want to move away from TSMC at all. They don't.
No.
But equally, it's probably sensible for them to diversify their sources of supply effectively, or manufacturing. So it's an interesting move. It's not clearly the US government has recognized the importance of Intel already. So this is, I think, it's another sign of albeit it's a troubled company. It's gone through a very difficult period, but it's equally a sign of the significance and the strategic importance of Intel to the US economy.
Let's come back to a more domestic issue. The FT ran a piece earlier today on a statement from Next's CEO, which was urging policymakers to stop making life harder for businesses. The point being that firms are carrying the weight of higher rates, regulation, policy uncertainty. Let's talk about what he said in that note, but also let's think about what the corporate sector, do you think the corporate sector is bearing too much of the burden right now?
In short, I do, yes. I have the utmost respect for Simon Wilson, Lord Wilson. He would, for me, be one of the top 5 captains of industry of all time. I mean, I think he's led Next superbly well for decades. He's an incredibly good communicator. He's very adept. He is pretty much the reason why Next has become such a dominant business. So look, it's a fantastic business. He's led it incredibly well. Lord Wilson is a political figure, but having said that, I absolutely agree with everything he has said. What he's highlighted is that UK business is being handicapped. In other words, growth in the UK economy is handicapped by excessive government spending, excessive taxation, excessive regulation, and in part the legacy of the budget issues that I've talked about on repeated occasions of last October's budget, which basically loaded a whole load of extra costs onto UK corporates. And higher taxation as well. So as a result of those measures, believe it or not, the UK corporate tax take is at an all-time high in the UK, certainly since the early 70s, as a proportion of GDP. That bears witness to the fact that the UK corporate sector has been milked by successive governments, and certainly by this government. And this is not helping the UK achieve the growth that it must achieve in order for the economy to be able to compete and survive and deliver all the things that this administration wants for the nation. So it's a warning shot. It's yet another very apt warning to the UK government. Please take your boot off the neck of corporate Britain, because we're struggling and the economy's struggling as a result of your ill thought through, inappropriate tax and spend measures. And I completely agree with Lord Wilson. Where we slightly disagree is that in the short term, what he describes as an anemic outlook for UK growth. He hasn't actually quantified what anemic means. But my view is slightly more optimistic. I'm more optimistic about near-term growth in the UK economy, because I think with lower rates, which we will see, and lower inflation, I think the household sector will start to de-emphasize saving behavior and start to re-emphasize consumption. And that sort of shift, if you like, in saving and consumption behavior is what will be the engine of growth. Basically, higher consumption spending will be, consumer spending, will be the engine of growth over the next 12, 18, 24 months.
And finally, let's end on some big numbers. The government has announced a $205 billion investment from the US into the UK, timed with President Trump's state visit. On the surface, that seems like good news. But I guess, as always, the devil is in the details. What's your take on this announcement, and how should we interpret it?
As with, not surprisingly, as with all of these sorts of events, governments like to sort of accompany these, well, I mean, not least Trump visiting the UK, a state visit. It's very, very important. What the government naturally wants to do is to announce some good news around that. And this is undoubtedly good news. The numbers, the bigger the better, frankly, from a politician's point of view. If you look into the detail, I mean, the number I read several hours ago was 110 billion, then it went up to 150 billion, and now it's at over 200 billion. But anyway, the point is that those numbers are not about investment over the next year or 2 years. But the Blackstone investment, for example, which I think is the biggest constituent of that 200 billion number, is spreading its investment over 10 years. And some of the other announcements are also spread over a number of years. This is undoubtedly good news. I'm not trying to poo-poo it. It's very good news for the UK economy. You've got a number of very big US institutions committing to investing in the UK economy. That has got to be good news for the UK. But I think we also need to moderate our enthusiasm a little bit, because this announcement comes hot on the heels, for example, of a number of high-profile pharma companies deciding not to invest in the UK, not just not to invest, but to withdraw investment, to shut down research infrastructure in the UK, because they don't like the sort of operating environment in the UK. They don't like the fact that drug prices in the UK are artificially suppressed by NICE and by the NHS. And as a result, Merck, AstraZeneca, and Glaxo have announced huge investment intentions in the US economy and are disinvesting from the UK, which is troubling and worrying. So all I'm saying is great news. It's really good that, along with Trump's state visit, which obviously is cementing a critically important relationship to the UK, the headline investment number is also good news, unequivocally, but let's not get carried away. It's spread over a lot of years, and it follows some worrying signs that other leading sectors are withdrawing investment from the UK.
So it's positive, but we should temper our enthusiasm.
Yep.
Well, plenty for us to think about, as always. Neil, thank you for sharing your views with us. We'll, of course, be back with more next week, but until then, take care.
Thanks very much.